NSE Investor Protection Fund and ET Now, together in their endeavour to educate investors across India, are back with the third edition of Nivesh India. Through interaction with market experts, experts from NSE and Anchor Insights, Nivesh India has helped investors unlock secrets to managing their wealth and has educated them about the power of compounding. Traversing the length and breadth of India, the Nivesh India Brigade has generated a movement that has spanned across 12 of India's fastest growing cities. After the success of Season 1 and 2, the third edition of Nivesh India is poised to become the platform to help retail investors to navigate Indian markets and understand the basics of investing in nifty ETFs. To set the context for the third edition, ET Now's Nikunj Dalmia spoke to Vikram Limiye, MD and CEO of the National Stock Exchange of India.
Well, the exciting journey of Nivesh India has reached its third year, and to take this year's Nivesh India campaign forward, the campaign which is committed to convert Indian savers into Indian investors, I have with me the Managing Director himself, Mr. Vikram Limiye. Mr. Limiye, welcome to the show. Thank you for joining us.
Thanks a lot.
Well, third year of Nivesh India, but 4 months for you at NSE. How has life changed for you?
Life's been very exciting the last 4 months. I think when you look at the prospects for India, I'm very optimistic over the medium to long term that India will continue to remain the destination of choice for investments. And the growth prospects are also very strong over the medium to long term. I think we have good macroeconomic stability and political stability. So I think India will continue to be a very attractive destination. Within that context, there's a lot to be done for market development. And while the equity markets are relatively well developed, even in equities there is a long way to go. And there are several other markets that remain to be developed, whether it's the bond market, currencies, commodities, and other associated markets. So I think for the next 5 to 10 years, I think there's a lot of excitement for investors, for markets, and certainly for exchanges.
But for you, you have come as a managing director of NSE when in general equity markets are vibrant. We've not had any big structural or cyclical shocks to the economy, and Indian savers for the first time are taking a leap of faith in equities.
I think that the trend is positive, and for two reasons. One is the economy over the medium to long term is expected to do well. So it's actually a good thing for investors to at least put a portion of their savings in equities. Second, obviously, as you know, alternative asset classes are actually not providing an attractive enough yield, and that is what is attracting some investments away from the other asset classes into equities. But the trend that is positive is the fact that a lot of these investments are also coming through SIPs and through mutual funds. So that actually is a positive trend, because you don't want retail investors to try and time the market. Invariably, people have got hurt doing that. And if people actually invest through cycles, which is what SIPs are supposed to do, then I'm sure the retail investor will have a positive experience in the equity market.
Even though if I look at the promise of rise with India can still be captured by equities, because equity is the best productive asset class, somehow Indian savers are always averse to invest in equities. Why is that?
There are a couple of reasons. I think one is transparency and governance standards over time have improved significantly. So what used to be a relatively opaque market today is a very transparent market, whether it relates to electronic trading, which brought about that transition relative to the open outcry system and the amount of time it would take to settle, and physical shares versus demat accounts. The evolution in technology, the evolution in settlement, the evolution in terms of how you trade, the transparency of pricing, corporate disclosures, the role of the regulator, and SEBI has also done an outstanding job over the last 15-20 years in order to make sure that trust in markets is good and improves. So on all those counts, things have changed quite a bit over the last 10-15 years, and so I think that is reflected in the fact that investors are now, or savers are now, willing to invest a portion of their savings in equities.
What is your sense on the role exchanges can play?
Exchanges have a very important role to play, as I said, on multiple counts, right? We're a quasi-regulator, so it's exceedingly important for us to make sure that trust in markets is maintained and in fact strengthened. So any kind of wrong practices, any kind of issues arising from trading members and other participants in the markets, we certainly have to be very watchful of, mindful of, and actually raise the bar on governance to make sure that there is transparency and trust of investors is maintained and strengthened. So that is a very important role to play, and that is a very serious responsibility that exchanges have to play. Second, obviously, is the role of exchanges in market development. And I've already made this point. I think market development is exceedingly critical to fund the country's growth over the next 5 to 10 years. And while equity markets are relatively well developed, even there is a long way to go. And we are seeing a pickup, for instance, in capital raising activity of SMEs. NSE has a separate platform for SMEs called Emerge. And we've listed 100 SMEs on that already, and the pipeline is exceedingly strong. So access to equities for MSMEs and SMEs is exceedingly critical. And that is another function that exchanges perform in terms of access to capital. Obviously, market development on multiple fronts, whether it's the bond market, currencies, commodities, which are relatively younger markets to the equity markets, those have a long way to go. And then there would be associated markets that develop, whether it's the interest rate futures market, the credit derivatives markets. So when you look at the landscape today, the way it is and what it could be over the next 5 to 10 years, exchanges will have a very important role to play in overall market development.
The ETF market globally, or which is now the talk of the world, that world is migrating from active management to passive management. In India, is the other way around. ETFs, even though pretty much everybody has a very unique offering, NSE has a lot of ETFs. The ETF market and the ETF structure or ETF commitment is not large. Why is that?
I think it's relatively early days in India versus globally, right? And so you have to try and track the evolution of ETFs globally as well. It didn't get to where it is in 12 months, 18 months or 24 months. So it takes time. It takes time for the product to mature. It takes time for investors to be aware of it. It takes time to educate investors in terms of what kind of returns you could make on ETFs versus actively managed funds. The cost structure of the two products is very different. So net of costs, the returns have to make sense. The argument that I've heard from asset management companies is that in India today, actively managed funds are still able to generate some alpha over and above the index product or above ETFs. That has to do with the structure of markets, that has to do with what kind of stocks can go into an ETF product versus an actively managed fund in terms of alpha generation. But I do believe that the trend of ETFs picking up is a given. I think it's only a matter of time when the size and scale of ETFs will also increase. And I think from an investor perspective, it is a relatively simple product. For a common man, particularly somebody who's coming into the markets for the first time, to try and understand actively managed strategies, whether it's value investing, growth, large cap, mid cap, balanced, is more complex than saying that, okay, you're investing in the market, the Nifty is at 10, it could go to 11 or it could go to 9. So that's the limited call if you have to take. It's a much easier call to take than trying to nuance that strategy based on a variety of different dimensions.
So to keep it very simple, would you say that for a first timer, someone who wants to participate in the India growth story, rise with the entrepreneurship skills of India, keep it simple, shell out 1,000 rupees and buy that top 50 companies in India by buying Nifty ETF?
Yeah, I mean, at the simplest level, if you just want to buy the market, then you just buy an index ETF and don't worry about anything else. But if you, for whatever reason, have a specific view on a sector or something else, then you could have sector ETFs, you could have all kinds of other ETFs. I just think it is simpler because you're just going with a basket view rather than a nuanced view of multiple sectors and a kind of strategy, whether it's growth, value, the kind of companies, whether mid cap, large cap. So depending on the sophistication of the investor, I would say obviously ETF is a very simple product. For somebody who does not understand markets very well or equity strategies or is a first time investor, I think ETF, even from a distributor perspective, would be quite easy to sell. The liquidity in trading of ETFs also needs to improve. So as you know, obviously the units have to trade and there has to be appropriate liquidity in the market for ETFs to trade, and there could be one or two things that need to be done in order to enhance the liquidity in ETF units, so that ultimately as the product picks up, there is enough liquidity in the product that goes hand in hand in terms of how the product develops and the popularity of the product.
But do you think there's tremendous scope for this product to develop?
I certainly believe so, yeah.
NSE has been an innovator in a lot of key categories, interest rate derivatives, the FNO market was created by NSE. So in terms of an innovation, what should we expect from NSE next couple of years?
We have a product pipeline, and product approvals obviously require SEBI approval. So it's very hard for me to just go and say that I want to do XYZ product, because that has to then go through a discussion with SEBI, and then based on what is approved is what we can launch. But we have a very active product development team, and there are various things that are being thought through in terms of what new products could be developed. At the current time, we're just trying to iron out a framework by which we can launch more products in a more streamlined way with SEBI, so that the time to market is cut short. But I can tell you there are lots of interesting things that should come up going forward.
Mr. Limiye, every bull market has a personality, and the last bull market was largely dominated by HNI and retail investors. This one is dominated by retail investors who are coming by the SIP route. So what is your sense when you look at the data, when you analyze the trends of this bull market? How different is this one from previous bull cycles?
I think it's fair to say that our dependency on foreign flows and foreign investors has gone down quite a bit, particularly in the last, I would say, 12 to 18 months. And that is a positive thing. Not that we are not dependent on foreign flows, or that foreign flows are not welcome. They're certainly very welcome. And as a country, I think we will require foreign investments into the country. So we have to make sure that our policies are attractive for foreign investors, and that certainly is the case, which is why you're seeing foreign flows come into the country. But for the longest time, we really couldn't counter any kind of volatility that arose on account of foreign flows, whether inflows or outflows, through domestic buying or selling power. And you really had LIC and maybe a handful of other large investors who could try and cushion that volatility. Now that is very broad-based, as you know, and the domestic mutual fund industry is exceedingly strong and only getting stronger. So I would say that is a big change from the markets of the past, because your domestic investor is playing a much larger role in determining the direction of markets and in determining the volatility of markets. And so from that perspective, it's a very positive sign. The other point I would make is that historically, the top 15 cities contributed the lion's share to AUM and in terms of where money was invested into the markets. Now you're seeing that more broad-based through the country, and so you actually see what we call beyond the top 15 cities. The AUMs that are being mobilized from cities that are beyond the top 15 cities is also a significant portion, and that is again a healthy trend. As long as we make sure that investor education keeps pace and that people know what they're investing in, and the product design and how products are sold is appropriately done in a responsible way, so that the retail investor has a positive experience in the equity market, I think this is a very healthy trend. A, the domestic investor, and B, within the domestic investor base, a more widespread mobilization of funds from across the country, not just restricted to the top 15 or 20 cities.
Are these very exciting times for the IPO market? Because on a daily basis now we've got 1 or 2 listings. There was a week in October when we actually had 3 listings on that day.
Yeah, no, I think, and it's good. I think for a while there was a lull in capital raising. That has picked up, and that is to be expected. As markets are doing well, people will use the opportunity to raise equity. The only point I would make is that over the last 6 months, if you look at the kind of capital raising that has happened, there are 2 things that have happened. One, I think a disproportionate share has been raised by financial services companies, whether it's insurance companies or banks, etc., NBFCs, microfinance, small banks, etc. And the second thing that has happened is a large percentage of the capital that has been raised is more from selling shareholders. So it's more in the nature of a sale of equity rather than primary capital being raised for growth purposes. So that again is part of the cycle, right? So initially, when markets are doing well, you will get investors trying to monetize. Then as growth picks up, which I certainly believe it will, in terms of the next few quarters, as GDP growth picks up, capacity utilization picks up, then companies will also start raising money from a growth perspective, because they have to invest in new projects, they have to invest in new capacities, etc. So it's part of the cycle. I do hope that the capital raising will be more diversified, and there will be more industries and more companies from diverse industries that raise capital, rather than, as I said, the concentration being largely in financial services so far.
Typically it is said that when there is frenzied activity in the market and when there is a huge uptick in volumes, that is a kind of an indication that markets are nearing that danger territory.
So you have to always worry about market levels per se, if you want to think about it in that context, relative to fundamentals. And what does it imply in terms of earnings growth, GDP growth, and is that justified relative to where market levels are? But the reality is that equity markets are always forward looking, and so if the view is that over the next few quarters growth is expected to pick up, and macroeconomic stability and political stability is here to stay, then somebody who's willing to take a longer term view will discount the growth prospects over the next several quarters, rather than waiting for that growth to actually be seen on the ground. So I would say that if you were to purely examine the growth numbers, including earnings, corporate earnings growth versus where the multiples are, you could make the case that fundamentals need to catch up. But if you believe that equity markets are necessarily taking a forward view, and you believe that growth over the next 2, 3, 4 quarters will pick up to justify these multiples, then you could make the case that these multiples are okay. You have to also remember that we're in a benign interest rate environment. I don't see interest rates going down from these levels, but I don't see them going up either anytime soon. And I think liquidity levels globally also are likely to remain supportive. Even the Fed is not expected to tighten in a hurry, and so global liquidity will continue to remain stable. Domestic liquidity is exceedingly strong, and so there are other factors beyond just earnings growth that are also playing into where market levels are today. But I would say we are trading at a premium to what our historical multiples have been, but the premium isn't at a level that should cause any kind of alarm, I would say. Having said that, you have to be watchful and mindful of where markets are, and the susceptibility to any kind of exogenous shock. And there are enough risks out there, particularly globally, and geopolitical risks, that if something wrong were to happen, then obviously the severity of the correction is also a lot more, because markets have run up a lot more. So you have to be mindful from a risk management perspective of where markets are. Do you have appropriate risk management systems in the overall equity markets? Are your margining systems okay? Are your settlement guarantee funds at appropriate levels to withstand any kind of shock? So all that we have to do as part of our job. But I would say there's no reason for alarm or anything at this point.
One very big misconception for a lot of old timers is that Indian markets are not safe. And this is where I would urge you to just send a simple message across, which is that Indian exchanges are so bulletproof now, both in terms of system and in terms of management, that we are unlikely to see cracks and crashes what we've seen because of exchanges in the past.
No, I would say that systems and controls and processes have come a long way over the last 10-15 years. That the kind of risks that could have existed in the markets 15 years ago have over time been mitigated significantly. That's not to say that you can plan for everything. I mean, there's always something new that could happen. But over time, there have been strengthening of controls, strengthening of risk management, strengthening of governance standards, strengthening of surveillance systems, investigation systems. I think the sharing of information with investors on a timely basis, so that every investor today gets a message every day on what he's bought or sold. So there's no way that anybody can play around with client accounts, because on a daily basis if something wrong has gone on with your account. So from a variety of perspectives, we have tried to plug the gaps that existed maybe 10-15 years ago, because of which there could have been some abuse by certain market participants to the detriment of the common man. Those have certainly been plugged. That's not to say that we've completed the exercise, But to your question, certainly much safer than where we were 10 years ago, and certainly more transparent, and from a governance and risk perspective, many of the material risks have been mitigated.
So like the NSE mantra is Soch Kar, Samajh Kar, Nivesh Kar. So the underlying here is a Nivesh Jarur Kar.
Absolutely. I mean, I think as I've said before, for an investor or for a saver, you should put a portion of your money in equities from a growth standpoint, but do it for the right reasons, do it with a longer term objective, don't do it to time the market, try and invest through cycles, put away a small portion that you believe conforms to your risk appetite. Just make sure that you're honest about what your risk appetite is, and it should truly be risk capital. Okay, so as long as you're putting away some portion of your risk capital into equities, you should be fine.
Has the final decision been taken on extension of trading hours?
No, by no means there's been any final decision or any kind of detailed dialogue surrounding it. My own view is that we have to, once again, we have to do what is good for markets, we have to do what is good for investors, and you have to try and create a level playing field for domestic investors and foreign investors. And so to that extent, if it requires, even in a limited way, to provide certain products that would put the domestic investor on equal footing with the foreign investor, it should be done, because otherwise it's not a level playing field. Cash markets don't have to remain open till late. I don't think there's any precedent for cash markets to remain open for 15 hours or 20 hours anywhere else in the world. But F&O markets do remain open. And in a limited way, if you're able to provide even an index hedge to domestic investors, at least they're not carrying overnight event risk that foreign investors are able to protect their investments from. So I think that's the limited point.
On a lighter side, a complaint which I often get from my friends is that why do Indian markets always trade on 1st of Jan when other markets are shut, even markets like Bangladesh are shut?
Yeah, because we are always optimistic and we want to get going from day one. Why lose even a day? Historically, markets have always been open, so there's no reason why they wouldn't be open this year unless it's on a Sunday.
I was hoping for a no for this answer, but I'll take a yes. Appreciate your time, and thank you for partnering with Ethan on this Nivesh India journey.